Let me just share the screen. That's recording. Okay. All right. So let's zero in now. What are statements of financial position and the statement of comprehensive income? So these, when you sum them together, they form what we call the basic financial statement. So when we are saying financial statement, what do we really mean? We are talking about the two things, okay? Mainly, we are talking about the statement of financial position and the statement of comprehensive income. I'll talk about them in detail. Just follow, just be able to follow. So now, financial statements, they will tell us the financial performance and the financial position of any given company through the statement of comprehensive income and the statement of financial position. Now, what is the statement of financial position, right? The statement of financial position, this one, it shows us what the company owns. Those are, we call them the assets. And it shows us what the company owes. Those are liabilities. Okay. So sometimes you call it the balance sheet. You are shown the assets and the liabilities. So the other name for the statement of financial position is the what? Is the balance sheet. Okay. So sometimes you can just be asking, can you show the statement of financial position? Then you'll be like, no, as we didn't learn this one, we just know the balance sheet. This is just as good as the balance sheet. We'll show you what the balance sheet is and the format that it takes. So what is the balance sheet? The balance sheet takes this form, okay? This is form of a balance sheet. I'll describe the elements that are here indicated on the balance sheet. Number one, okay, we have the assets. With the assets, we begin with the non-current assets. The non-current assets are also called the fixed assets. Okay, the non-current assets, which are also called the fixed assets. So what is there on the non-current assets now? On the non-current assets, you have things like the land and the building. Those are assets that are able to stay for more than 12 months or for more than 1 year. The things that belong to the company they have monetary value, okay? And they can stay for more than 12 months before they can be converted into cash. So plant and equipment, motor vehicles, these, they comprise, they form what we call the non-current assets. Under the current assets, we have the following things. This is just the format. NLS can't see the screen. Is it with all of us that we can't see the screen?
It's showing on my end.
Yeah, so NLS, what you do, try to log out immediately and try to rejoin. I'm sure you'll be able to see what we are trying to do. Yeah, I'm sharing the screen. Yeah, just log out and rejoin. Okay, thank you. Yeah, so what is on the assets? We have things like inventory. Inventory is still called the stock, okay? Inventory and the stock is one and the same thing, and we will define these things later on. We have accounts receivable. These we also call them the debtors. In some writings or in some literature, you find them labeled as the debtors. The accounts receivable or the debtors, those are people who owe the company, okay? They have things that belong to the company, or they are the customers to whom you supplied things on credit. They owe you. Then payment is an asset, simply means you pay in advance. Take, for example, you pay for rent in advance, or yeah, you pay your workers in advance. So whenever you make payments in advance, those are called the prepayment. Yeah, you really need to pay attention and understand the financial
Sorry, sir.
Yes, madam.
If Madam Veronica could kindly mute her mic.
Okay. Veronica, Madam Veronica. Madam Veronica, kindly mute your mic. We are asking that you mute your mic. Okay. I'm sure it has just done that. Okay. Yeah. Then from there, what we have is we have cash in hand. Okay. The cash in hand and the cash at bank. The cash in what? Cash in hand and the cash at bank. All these things, they form what we call the what? The current assets. Follow nicely the format of the balance sheet. This is the easiest format that you can use. And I would recommend that you use this simplest one and the easiest one in this time around, especially. Yeah. Then from there, you have, after you've totaled up all your current assets, you've totaled up your current assets. These are current assets. Their sum is this one. And the fixed assets are these. Their sum is this one. Then you add them together to form the total assets. And the total assets are here. So when you add the fixed assets plus the current assets, you form the total assets, just like that. Then from there, you have capital and liability here. So you begin with the capital always. Capital that you introduce, that you have, these elements will be given, by the way, these elements will be given on a trial balance. They'll be given for you. I'm just showing you the format. You write, you record the number here. The net profit will show you how to calculate for the net profit. And then you remove the drawing. Okay, the drawing is what I think that is the money that you withdraw as a proprietor from the business for personal use. You withdraw this money so that you can use it for your own, for the personal use. So you have to deduct that money. And what remains is what we have here, 51,600. Then from there, what you will have to do is, to add the non-current assets. The non-current assets, the non-current liabilities. The non-current liabilities, these are the liabilities or the things that the business owes, okay? Like you owe your customers and you're supposed to pay them after 12 months. Examples would include loans, okay? So all the non-current liabilities are listed under here. You sum them here. In this example, we just had only one, a loan, of course. Then you have current liabilities. The current liabilities, those are obligations that you as a company or as a business, you are supposed to meet before 12 months. For example, the accounts payable, these are also called the creditors in other literature. The creditors, those people supplied to you on what? On credit. These are suppliers who supply to you on credit. So you owe them, you're supposed to pay them. You have the bank overdraft. When you overdraw from the what? From the bank, you withdraw more than what you have in your bank account. That's called a bank overdraft. You are supposed to pay that. And you have the outstanding tax or tax payable. Those are current liabilities. You have accrued expenses. So the accrued expenses, these are expenses that you are supposed to incur, even if you haven't just paid them. So you are supposed to pay. For example, you owe your workers. You have not paid your workers for 3 months. You owe them, and you are supposed to pay them. So those will be called the accrued salaries, okay, because you will need to pay your workers. Accrued rentals, you have been using the facility for some time and you have not just paid the rentals to your landlord. And you know that after some time, you need just to pay. So accrued expenses are recorded as liabilities or current liabilities here. So what you do from here, you add all the current liabilities. You add all the current liabilities and then add them to the what? To the long-term or the non-current liabilities. So the sum of the current liabilities is 7,300. You just add these two and you have this amount that is total equity and liability. If you have observed, you can see that this is now equal to that. What we are trying to do is to obey the accounting equation. The accounting equation that says that the total assets are equal to what? To total equity plus liability, right? You say capital plus liability. So total assets is equal to capital plus what? Liability, which is same as the total equity and liability. So these, they should be equal. So once you have this, or you're following this format, you're using this equation, this accounting equation. Okay, this form of this equation. However, comma, there is another form of this equation, the form where you can say assets minus what? Liabilities. Okay, when you have assets minus liabilities, it should be equal to what? Capital or to equity. So that is to say, once you remove assets, you remove liabilities from assets, you have what is called net assets. So here, where there is total assets, you have net assets. But that's not the format that I want you to get as for today. As for today, just to get this one, I have explained. So do I have any question from anyone on how to, on the format of a balance sheet and what it is? Any questions from anyone? You need to go slow and understand this. We will be slow, but you just really need to understand this.
Yes, sir. I've got a question.
Yes, sir.
Just come again on the purpose of statement of financial position, which is the balance sheet.
What is the purpose? The purpose of the balance sheet? Are you asking
yes,
about
what does it do?
Of the... Oh, okay. So the balance sheet is a position, is a statement of financial position. That is to say, it shows us how much we owe, okay, our let's say our suppliers, like the people we owe, those are liabilities. How much liabilities we have, how much of the things that we have in the business do not belong to the business, those are liabilities. And how much of the assets are the things that belong to us as a business we have, how many of these. So we are trying to weigh the balance. That's why it's called a balance sheet. We're trying to weigh. So if you find that you have got a lot of liabilities, it simply means not as a government, sorry, as a business, you are in danger. Of course, you owe. You have a lot of credit. You owe a lot of people. Most of the things that you have do not belong to. Then if we have a lot of assets more than the liabilities, then we are okay. Did you get that?
That was clear.
That's fair then. From there, the next thing that we have is, let me try to define now these elements for you. I don't want to rush on this piece of study because it's coming in an exam. So let's just follow nicely. What are assets now? Let me try to define these things. So the assets are defined as just, let's say an asset is just anything owned by the business, okay, that has monetary value. We do include motor vehicles, inventory, just those assets that I've already talked about. So anything that belongs to this business and has monetary value. Okay. Non-current assets, these are assets that the business intends to keep for more than 12 months. Okay, for example, land, equipment, machinery, those things you intend to keep them for more than 12 months. Current assets, these are temporal. Usually they can easily be converted into cash and within 12 months. That's why they are called current assets. And inventories are basically the goods that have been purchased or by the business that are intended for sale. Okay, you are keeping those things. They're not same as the purchases, by the way. Like you are keeping those things so that you can sell. For example, you are producing your butter, like butter, butter shoes. Those guys, the butter guys, they produce a lot of shoes, and some of the shoes are kept in stock. Okay, they are just kept so that they can sell them later when the customers come. Okay, you don't just produce it. Okay, like today the customers have come, then you produce, you give them, or you tell them, wait, we produce for you. You produce, then you keep in stock. You have things like flour for making bread. You have those things you keep in your storehouse. The accounts receivable, I've already highlighted. These are basically the money owed to the business by its customers, the debtors. The money that they owe, we call them the accounts receivable. Prepayment simply means paying in advance. Okay. Having said all these things, do I have any questions from anyone? All right. We can pass a comment now on the statement of comprehensive income. The statement of comprehensive income, or the statement of profit and what? And loss. The statement of profit and what? And loss, or the statement of comprehensive income. This one is the profit and loss account. Okay. What about it now? The income statement gives you a summary of the income and expenses. So a business can declare profit only if the income exceeds the expenses. However, when the expenses are more than the income, then the business would declare a loss. So what the statement of comprehensive income, or the profit and loss account, is giving us, is trying to show us, have we made profit when we are trying to trade? Did we make profit? How much revenue have we generated? How much of the expenses we incurred? Did we make a loss or a profit? So that's what we are trying to study as a business. So it follows the following format. This is the format. Number one, always you will have your profit and loss account starting with the sales revenue, the sales. Okay, you record the sales, and from the sales, if you have sales return, then you should remove the sales return. I'll comment in the next few minutes about that. Let's just stick to this, what we have right now. From the sales revenue, you remove the cost of what? The cost of goods, or less the cost of goods. Now, under the cost of goods, you have these things there, the ones that make the cost of goods. the opening inventory, and then the purchases. We know the purchases, those are things that are bought for resale. You buy things so that you can sell again. Yeah. Once you add that, then you can less. You know that these brackets, the brackets mean, these are not brackets, they are parentheses. They mean subtraction. So it's a minus. We are subtracting the closing what? Inventory. Once we subtract that, the sum that we get is the 100 and what? And 10. This 110 will be subtracted from what? From this 180. So you say 180,000 minus 110 what? 1,000. So once you subtract that, you have that what? 70,000. This 70,000. This 70,000 is called the gross what? The gross profit. Follow nicely. I don't want to speed up. Just follow nicely. So we are saying you are given the sales. These details, by the way, they are there on your trial balance. They are there. They're given to you and these figures. So we're just showing you the format where to record what and where to record what elements. So the sales, you write the sales. Then from the sales, you deduct the cost of goods. And the cost of goods will start with the opening inventory. The opening inventory, yeah, like the stock that you have come with in that particular period under concern, it will be given. We'll show you when you do an example. There'll be examples, by the way. Don't worry much about it. Just stick to the concepts in the meantime. And you have the purchases. Then you less the what? The closing inventory, and that sum you should subtract it from the what? From the sales to make the gross what? The gross profit. Now that you have made the gross profit, to the gross profit you will add the other what? The other income. The other incomes will include things like rent received. If you receive rent, you receive a rent. Not you pay a rent, by the way. You receive a rent. Things like the interest you receive. You receive some interest. And you have received the discount. You have received the discount. You add all those things as other income to the gross profit. Once you're done doing all those additions, then because you know that the sum of these other incomes is 11,000, you add it to the 70,000 to make 81,000 now. From this 81,000, you will subtract the expenses. The expenses include rent. You pay the rent as a business. The rent that you pay as a business, electricity, telephone, the wages and salaries, the motor expenses, and the many more expenses that we're going to talk about in this conversation. So all the expenses are listed here under. You sum them up. After summing them up, you have them here as what? It's at 1,000. Then you deduct them. Okay. The expenses should be subtracted from this total revenue. This one is called the total revenue. The 81,000 is the total revenue. Okay. So you say this 81,000 minus what? Minus 81,000. 81,000 minus 81,000, it gives you the 50,000. This one is called the net what? The net profit. Remember on the balance sheet, we said that we add the net profit to the capital, right? This is the net profit now. This is the figure that you add there. Financial statements will come with a lot of marks. If not 20 marks, then it will be 25 marks. So you just have to pay attention to this one. This time around, I call for questions again. Do I have any questions to pick on the profit and loss account?
Yes, boss.
Yes, sir.
Yes, Clifford speaking. On the cost of sales, I think make me understand. because the opening inventory and the closing inventory, it's really confusing me because I don't really understand why you're putting them on cost of sales. So maybe when you explain the meaning of cost of sales, I'm going to understand why you're pressing these two here.
Okay. Okay, thank you very much. Cost of sales. All right, first of all, let me begin by underscoring that the cost of sales is not same as the expenses. Okay, the cost of sales is not same as the expenses. So we are trying to examine and find all the costs that was related to the sales. Okay, we are examining all the costs that was involved. Okay, all the costs. So when you're dealing with the cost is attached to the sales. So you make the sales, then you remove all the costs. Now, why should you add the inventory, just as you say, the opening inventory, and then you remove the closing inventory? You want to find the difference. Like you need to find, you want to find the difference between what the things that you brought in as a business into the business from the previous period and those that you have ended with. So that's why you remove, you add this, the opening, you have this opening inventory, and then this closing inventory, you remove it. So because we are just concerned with what has occurred within that period under concern. Let me just maybe highlight that it's just this one is just the best one. We'll still give further explanation in the next slide. Like I will still come back to these things and pass comments on the same thing. They'll be more clearer. Maybe if they are not clear now, they'll be more clearer.
Okay.
Sure. All right. And let me show you the other format, because we are trying to build now the format of the profit and loss account. It usually has a lot of elements that confuse people, but if you can just understand this, then you are fine. You are okay with that, then I'll be okay as well once I know that you really understand this. Okay. Let's build again. We are building the profit and loss account, just the one we had previously. Yeah. Let me just highlight that we have not rushed into the questions. The questions are there. I have a lot of them, but we can't just go directly to the questions before we can understand the concept. Please understand the concept here as I'm trying to explain, so that it will be easy for you to connect once we bring the question and try to answer the question. When you're given the sales from your trial balance, of course, you're trying to come up with a profit and loss account. You start with the sales just as we did in the previous one. The sales, then you less the cost of goods, just as we said. Now, if you don't have the opening inventory on the trial balance, okay, you just write the purchases, and then from the purchases, you will less the closing the closing stock. This is just according to the information they have given you on the trial balance, okay? You just check on the trial balance, like how much information they have given you, and that is how you will write. So just follow nicely. So now we assume that we are just given the sales. After the sales, we have the purchases and we have closing stock. We don't have the opening stock. This is how you will write. And you will subtract the closing stock to make this 60,000. That you will subtract from the sales, and you have 12,500 as a gross profit. From the gross profit, you can remove all the expenses. Now, we assume that now we don't have the what? The other income. That's why I have not added them. See that in the previous period, we had the other income. Now we don't have the other income. That's why we're not adding them. Okay. So you just go straight to subtract the what? The expenses. Subtract the expenses. You sum them together here. You make 4,500 and subtract it from the what? From the gross profit, your 12,500. This 8,000 here is called the net what? The net profit. All right. We are still adding some features on to the profit and loss account so that you get it clearly. Now observe that we have added another feature. We have added another feature. Okay. We have the sales. Then now we have the sales what? Return, or the returns inward. The returns inward or sales return is just one and the same thing. Okay. The returns inward or sales return is one and the same thing. So you need to subtract them from what? You need to remove them from the sales to make the net sales. The 38,500 will be called the net sales. So from the net sales now, you can less now the cost of goods. That's when you can subtract the cost of goods. Assuming that you don't have the opening stock again. If you don't have the opening stock on the trial balance, you just write the purchases because you just have the purchases. And then you have the returns outward. What is the returns outward? The returns outward, these are things that you as a business, you have purchased, then you have decided to return them to your suppliers. Probably they don't meet your standards, or they have the problem, or they have some defects. You return them. So you remove them from the purchases. After removing them, you remove the cost of what? The closing stock. Then whatever the sum you get, you remove it from the what? From the net sales, and you form the what? The gross profit. Then from the gross profit, you can remove the expenses that we are just talking about. All right. From there, we are trying to add features. Follow nicely as we are adding features. Again, now, from the sales, we have the sales what? We have the sales return. We have the sales return. Anyway, you know how to handle this one now. And which new element is it? The returns outward, we commented on them. Carriage inward.
Carriage inward,
Observe
yes.
that the carriage inward is now added. Okay, is added immediately after removing the returns outward. That is, if you have the returns in the carriage inward on your trial balance. What is carriage inward? Carriage inward simply means the cost that or whatever you paid when you're trying to bring the things into the business. That would include offloading costs, okay? Offloading costs, as we are trying just to bring things inside the business. We call that cost you incurred is called what? The carriage inward. It would include transport and yeah, that's carriage inward. So you should add here as the cost. Then you should less the what? The closing stock, and whatever you have, you subtract now from the net what? From the net sales, then you can have the gross what? The gross profit. From the gross profit, you can less the expenses, all the expenses. We are adding features. Let's add another element now. You have already seen that we start with the sales always. If you have sales return or returns outward, returns inward, you should subtract them from the sales. But if you don't have them, you can go direct to subtract the what? The cost of goods. Under the cost of goods, now you have the opening stock. You start with the opening stock. Then to the opening stock, you add the purchases. To the purchases, if you have the returns outward, okay, or purchases return, sometimes it will be written as purchases return. Purchases return, right? You should do subtract. But since we don't have in this context, you will not do that. And if you have carriage inward will be added here. But if you don't have, you will not add. Then you will list the what? The closing stock. The closing stock will be what? Will be subtracted, and then you have to subtract whatever you have found from the net sales or from the sales, and make the gross what? The gross profit. If you have other income, you will add them here. Since we don't have other income, we'll go direct to removing what? Expenses. We'll subtract all the expenses. In this respect, we have the wages, we have lighting, we have rent, we have general expenses, sundry expenses, and observe that the carriage outward is an expense now. Carriage outward is a cost, it's an expense, not a cost. It's an expense that you incur as you are trying to carry things outside. For example, maybe you are returning the goods or you are supplying goods. That transport, it will include the loading cost, right? You bring some people to load, okay? Yeah. Whatever the expenses that you incur, they are called the carriage outward. Then from there, you will remove that from the gross profit and make the what? The net what? The net profit as well, which is very necessary, and you need it on the trial, on the balance. Having said all these things, I now call for questions from anyone. Is there any question from anyone before we do the example? Just the example, then we call it a day. We'll call it a night. Yes, ma'am.
Yes,
The carriage inwards.
Sorry, I didn't get. I just heard the carriage inward.
Maybe you can elaborate more. I missed your point.
On carriage inward.
Yes, sir.
Okay, Mr. Chituka, your hand is up as well.
Yes, even me.
yes, I just want to find out what if when you are doing the profit and loss account, when you are writing in an exam, you forget to, before you even end, you forget maybe to less the closing stock. Then you remember maybe when you are doing the expenses, can you fit it somewhere below there so that the figure adds up, or what do you rewrite everything?
Oh, okay. All right. Let me try to handle the two questions. So starting from the carriage inward. So about the carriage inward, we said that the carriage inward is the cost that you incur as you are trying to bring in the things into the business. Carriage inward, as you are trying to carry the things, it would include the transport and maybe the offloading cost. There are those times when you call people to offload or whatever the cost that you incur around that, trying to facilitate and ensure that things come into the business, those goods. It is called the carriage inward. Then carriage outward is the opposite. As you're trying to take the things outside the business, whatever the expenses that you incur, it's called the carriage outward. Is the questionnaire clear?
Yes, it's answered, sir. So basically, even carriage inward, since it's an expense, so it is put on the expenses.
Carriage inward. It's not an expense.
Yes.
Carriage inward is not an expense. It's a cost. So carriage inward is a cost, then carriage outward is an expense. That's how different they are. You've seen carriage inward, I've circled it, it's under cost. Okay. Then carriage outward, carriage outward is it's here, it's under expenses. You see, right? It's here. These are expenses.
Yes.
Okay. Thank you. Then back to Mr. Chuka, I was saying, like, what do you do when you realize that you had not seen the closing stock? Immediately, if you find that you had omitted the closing stock, it means that your gross profit is what? Is wrong. And what you do, you can go back to rectify, because the closing stock is just affecting what? This part, right? You can rectify this part so that whatever you make, so that you can subtract the expenses from the corrected thing. Because if you just go straight, then everything is wrong. Is that fine?
Yes, it's fine.
Okay.
Good evening, sir.
Oh, yes, sir.
Yeah, I'm actually a bit behind on the sales. Can we say the sales is actually the balance brought forward?
Or like the sales, all those, yeah, whatever figure we find on the trial balance, it was the balance brought forward. It was the balance brought forward from the T account.
Hello.
Yes, sir, I can get you.
Yes, I was saying that when if you do some class on how we come up with the trial balance, you'll understand that all those figures that you find, they are actually, the trial balance is made up of the T accounts, the individual accounts, the T accounts, and from the T accounts, you close the T accounts. Then when you're closing the T accounts, you always have the balance brought down. So how you come up with the trial balance, you always pick the balance brought down. So it is basically the balance brought down. Is that fair?
Okay, I understand. Now, again, I have a concern on the carriage inward.
Carriage inward.
Yes, looking at it's actually appearing on the part of income there. But how come it's on the part of the cost when it's supposed to be an expense?
A carriage inward is a cost. It's appearing on the costs.
Okay.
Yes, it's appearing on the cost. It's a cost, carriage inward. Then carriage outward is an expense. That's what we've said. It goes to the expenses. That is the correct format that you need to follow whenever you're handling this.
Okay, noted.
Okay, sir. We can just do one example. Then after doing one example, then we can at least call it a night for the adjusted financial statements. You have seen the trial balance. This is a trial balance that we have. This is our trial balance. And from the trial balance that we have the following elements. We have the purchases, we have the sales, we have the cash at bank, we have the cash in hand, we have the capital, we have the drawings, office furniture, rent, wages, salaries, discounts. The discounts are two. Discounts allowed, discount received. You have debtors and creditors. You have stock, opening stock, okay? One match. You have that opening stock. You have the provision for doubtful debt, delivery van running costs, and the bad debts written off. Then you have the following adjustments, see, to make. Okay, you have the following what, see? Adjustments to make. So you need to make some few of the adjustments. After making the adjustments, you draw up the what, see? The trading and the profit and loss account, which means you come up with the statement of financial comprehensive income. Yeah, the statement of comprehensive income, and then you draw the balance sheet of this. So now, what's the time? 10:03. The question has adjusted financial statements. So what I'm going to ask you, these sound to be more like another deeper conversation, but what I'm going to do is I'd ask the co-host to stop recording. Mr. Co-host, sir, you can stop recording.
Okay.